Good afternoon, everybody. Thank you for joining us for the first PBO Budget Insights Seminar for 2023. Welcome aboard. Just a couple of housekeeping things before we get started. My name is Heather. Welcome along, and we'll be joined today by Cameron Chisholm, who'll be presenting our topic. He's one of our tax experts within the PBO. So some housekeeping for you. We will press record on the meeting. In fact, I think we are already. So we'll be making this available through MOPS Learning. So if you yourself want to re-look at it, or any of your colleagues to have a look, it will be available there for you later. So because of that, if you could keep your microphones off until we get to the questions section. But through the presentation, if you do have any questions spring to mind, please feel free to drop them into the chat and we will make sure that we come back to them at the end. So I thought I'd start with a question for all of you first, and get ready to use your little raise your hand or thumb reaction there. I'm just interested to know of everyone who's joined us, do you have any experience in the field of tax, income tax, tax policy, implementation or anything? Give us a thumbs up if you do. And it's okay if you don't. I don't. I'm not seeing any. It might be a new crowd for you, Cam. Oh, we've got one. Excellent. Was that you, Cameron?
No, that was not me.
There's a few. Great. Thank you, guys.
Yeah.
Well, I'm going to hand over to Cam now, who will take us through the presentation. And yeah, like I said, drop any questions you might have into the chat and we will get back to them. Thank you, Cam.
Thanks very much for that introduction there, Heather. So today we will be talking about personal income tax, and we'll be doing a little bit of a historical look at some of the things that have happened to personal tax in the past, as well as looking forward into the future to see where we're going. Now you might ask, why personal income tax? And the reason for that is at the PBO, we're looking to highlight things, fiscal risks, and some of the things that are going to be affecting the budget in future. And personal income tax is our largest source of revenue. So naturally, it's something that we're looking at regularly. So look, before I start, I'll just note I'll probably talk for around about 20 minutes. At least that's my intention. But as Heather said, feel free to drop questions into the chat. There will be a chance at the end for questions as well. So look, just as a little bit of an introduction here, I've mapped out roughly what our personal tax system looks like. In Australia, we have a progressive tax system, and we use marginal tax rates to achieve that. What this means is that people, when they start earning an income, they don't pay any tax at first, and then eventually their tax hits a certain point and they start to pay tax on every additional dollar they earn from there. They hit another point and their tax rate goes up, another point, the tax rate goes up again. And what that works out is, as your income goes up, your average tax rate increases as well. Hence what we mean by progressive. And so that means higher income earners pay a larger share of the overall tax, but also a larger share of their own income. Now, one of the things with a progressive tax system is we get something called bracket creep. You've probably heard this term thrown around a lot. What that actually means is, as your income grows, if there are no changes made to the tax system, then naturally you pay a higher share of your income in tax. And that kind of makes sense from the perspective of a progressive tax system. But from an aggregate level, it also means that if everybody's income grows, and that tends to happen over time, then the government takes in a larger share of personal income tax, even relative to the size of the economy. Now, this is our tax rates that we have in 22-23. Just for completeness, in 24-25, there are tax cuts, and that light blue line is what our marginal tax rates will look like from that year. So When we look at personal income tax, what we're going to do today is we're going to explore it from the perspective of 3 tax principles. The first one is efficiency, and really what we're talking about there is how much does personal tax, I guess, have an effect on economic activity. All taxes tend to have some negative effect on economic activity, but yeah, we'll look at it through the lens of personal tax, as well as how we raise our taxes relative to other countries. We'll then look at it from the perspective of equity and how that's changing over time. And finally, from a whole of budget perspective, sustainability. So we'll start off talking about efficiency. Particularly, I'm going to talk about how much of our tax comes from personal income, and then how our tax mix compares with other OECD countries. So on this chart here, that at the moment is just a single dot. The x-axis there, we've got total tax as a share of GDP. You can see that in 2020, Australia raised just under 30% of its total tax as a percentage of GDP. And I'll note that this is tax raised at all levels of government, so Commonwealth, state, and local government. The Commonwealth share is, I think, closer to about 23%. Then on the y-axis there, we've got the share of that tax that comes from personal tax. And for Australia, it's around about 40%. So 40% of all of our tax revenue at all levels is coming from taxes levied on individuals. Now, I'm going to put other OECD countries on this chart, and you can see, we're not quite at the centre of the distribution. The one highlighted in the centre there is the average across all OECD countries, and I'm just going to put a little crosshair on there. And you can see that Australia is in the top left quadrant here. We're a relatively low taxing country overall, but we raise a relatively high share of our tax from personal income tax. If you look in contrast, countries in the bottom right quadrant are higher taxing countries who rely less on personal income tax. Now, one of the great things about this chart here, which I've got some clever colleagues who have put this together for me, is you can go back in time and see how these things have changed. And I'm going to go all the way back to 1965. I've kept that crosshair there for the 2020 average just for comparison. But you can see that if we go back nearly 60 years, unsurprisingly, most of these advanced economies raised a lower share of their GDP in tax. And Australia was a little bit behind the average then, and still a little bit above in terms of our reliance on personal tax. Now, I want to highlight what happened over the next 20 years. I'm going to go forward to 1985. And what you can see there is a general movement of countries across to the right. So demand for government services increased, and people were willing to pay more tax as well. And so if I just click on the OECD average, you can see what actually happened over this period. So countries went from an average of around about 25% of GDP raised in tax, and finished up at around about 32% of GDP. Now, I can click on Australia as well, and just like the rest of the OECD, we went across to the right of the chart as well. Key difference for us is that we increased our tax take primarily through increasing taxes on personal income, whereas the rest of the OECD managed to do it without increasing personal income tax by as much. Now, I'll go ahead another 15 years to the year 2000. And you can see here, there isn't as much of a shift across to the right anymore. If anything, the shift is more downwards. And what's happened here is a lot of European countries in particular started to introduce things like value-added taxes, taxes on consumption. And in doing so, they were able to reduce their reliance on personal income tax. Now, Australia also introduced the GST at this time, so that's why you get this drop down here. And we did that at the same time as significant cut to personal income tax. Now, if we go, I'm just going to go to 2009, which is kind of post the global financial crisis. You can see Australia kind of bounced around a little bit, but with the GFC, our tax take moved across to the left quite significantly, and much more significantly than the rest of the OECD. And I think the main reason for that is we were in a mining boom where our tax to GDP was probably at quite a high level, and we went straight from this boom into a downturn. So we went from like a peak down to a trough, if you like. And I'll just go forward to the end of the period, 2020. You can see there hasn't been that much of a change over the last 10 years or so. Australia's sort of bounced around a little bit. We haven't really changed our overall reliance on personal tax at all levels of government, and the OECD has been around that same level as well. Now, if I move the crosshair to where Australia is, you can see that there are actually very few countries that are more reliant on personal tax than us. The USA is an interesting case. They raise less tax overall and slightly more personal tax. This is Iceland over here. They higher taxing country than us, and then you've got this outlier, Denmark, over to the top right. Very high taxing country, and they do it primarily through taxes on personal income. Now, I'll go through just to the next slide. This one's probably not quite as dynamic as that first one, but this is now looking at just the Commonwealth, and it's the share of total Commonwealth tax receipts that come from personal income. And you can see going back to 1960, just how much of an increase there was. And I'm actually going to zoom in on that period as well. We got about a third of our revenue from personal tax, and over a 15-year period, that increased to more than 50%. And the primary reason for that was bracket creep. So governments at the time kept the tax rates and thresholds pretty consistent, and people, their income grew and they moved into higher tax brackets, started paying more tax. And so, letting bracket creep run for a substantial period of time really increased our tax take quite significantly. And then if we look from 1975 to 2005, we had a period where our reliance on personal tax was pretty consistent up until the point at which the GST was introduced. And I highlighted that before. There was a big tax cut as well as a new tax. So we went from about 55% of our tax from personal tax down to just above 45%. And from there, around about 2005 to 2018, it's a little bit hard to see with this scale. So I'm just going to adjust it a little bit, which is one of the great things about these interactive charts. You can see that after we kind of bottomed out at the GFC, we've let bracket creep run for about 10 years. There weren't sort of major tax cuts over that time. And so our reliance on personal tax has once again gone above that 50%, peaking in about 2016 at 51.5%. And then looking ahead to the future, we know we've had 3 stages of tax cuts, or we've had 2, and there's the third one scheduled for 24-25. That has temporarily put our reliance on personal tax down, but over the next decade, what we're expecting to see is, well, at least what's projected in the budget, is bracket creep driving up our share of tax from personal tax once again. And so that's not dissimilar to, I guess, what we've seen in that kind of early 1960s to 1980 period. Of course, that's just on projections on current government policy. There's all these things are, of course, subject to change in future. So I guess before we move on to the next section, I just want to highlight a couple of things about tax efficiency. So first of all, the more that the country has a reliance on a single revenue source, that means the tax rates necessarily have to be higher. And in terms of like the economic literature, higher tax rates generally have more of a negative effect on the economy. So that's one potential, I guess, risk in our approach to raising revenue in this way. The other thing about personal tax is because it's generally levied on the working age population, as the population ages and the proportion of the working age is reducing, that means in order to raise the same amount of revenue, those tax rates have to keep going up. And that's something that could become a source of fiscal pressure in the future. So we'll move on to the next section, which is equity. I want to talk a little bit more about bracket creep and why it hits middle income earners more than others, as well as why bracket creep in particular actually reduces the degree to which the tax system is progressive. So just before we go into some other measures of progressivity, I've just got a chart here where on the top we have the average tax rate. So this is basically, of all the tax paid divided by total income, and we can see how that has changed over time. I can even put in some arrows showing some of the things that have happened, particularly things like the new tax system tax cuts, like the GST, tax cuts during the mining boom, increase in the Medicare levy, and more recently stage 1, 2, and 3 tax cuts. On the bottom chart there, we have the decomposition of the change to the average tax rate. And I want to first of all highlight bracket creep. Now, if we look back over just about every year, back to 1960, you can see that bracket creep has increased the average tax rate. And that's because incomes almost always grow over time. Even in periods where there's very little real wages growth, we still have inflation, and inflation leads to bracket creep as well. Now you can see periods where bracket creep was very, very high, particularly in the early 70s, and that was when we had very high levels of nominal income growth. More recently, it's been a bit more subdued. That's because we haven't seen those periods of 10, 12% income growth more recently, but we still do get bracket creep that can accumulate over time. Next, I'm going to highlight changes in policy over the same period. And you can see that like the negative bars there are tax cuts and the positive bars are tax increases. There have been a few tax increases, but the overwhelming number of policy changes, and particularly all the big ones, have been tax cuts. And you can see, there were very few, like I said before, very few tax cuts in the 1960s. And then starting around the early and mid 70s and 80s, there were very regular tax cuts. And that was because, there was quite a lot of bracket creep at that time. And so big tax cuts were necessary just to keep pace with bracket creep, if you like. The biggest one, of course, is the 2001 introduction of the GST. But more recently, you can see stage 1, stage 2, and the stage 3 tax cuts on there. So what does it actually mean for tax equity or tax progressivity? Well, progressivity, there's not necessarily a single measure, and different people will have different views about this. But what we've decided to do here is just a simple metric, which is the share of tax paid by the top 10% of earners. Now, our system is quite progressive. The top 10% of earners pay around about half of all tax receipts, but it has varied over time. And I'll go into a little bit of the reason for why it's changed so much over time. So if I look back again, that 1960 to 1980 period, as highlighted earlier, there's a period of bracket creep. There were very few changes to the tax system at that time. And what happens when bracket creep occurs is, because middle income earners are primarily the ones being pushed into high tax brackets, they're the ones who then start to pay more and more tax, reducing the share paid at the very top level. So you can see the share decline from about 50% down to just above 35% over this 20-year period. Over the next 30 years, where we did see a lot of those tax cuts, a lot of those tax cuts were targeted at middle income earners. And so that doesn't mean the top 10% didn't receive some of those tax cuts as well, but in proportion to the tax being paid, they were more targeted at the middle income. And so we saw the share of paid by the top 10% start to go up. And when the GST was introduced as well, that was quite a significant change in the distribution of tax paid. And then since 2010, where a period where bracket creep has been, I guess, let run a little bit more than it has in the past, we're starting to see more of a decline in the share paid by the top 10%. And I'll just make this a little bit more obvious by changing our axes here. So yeah, we sort of around about 52% in 2011, coming down to around about 49% in 2023. And then, there were obviously some further tax cuts, but primarily what's driving this decline over the next decade is actually bracket creep, because again, more middle income earners are being pushed into higher tax brackets. So bracket creep, I guess that is one of the costs, if you like. If we think it's a good thing to have a progressive tax system, well, and we decide on the right level of progressivity, well, that will change over time if governments don't do anything about bracket creep. So the last section here is sustainability, and I'm just going to show you the one chart here. What we're going to look at is the debt to GDP ratio, and we'll see that this is on the current projections, is stabilizing over the medium term. But we'll also see that bracket creep is a key driver of this stabilization, and that there are some risks involved in relying on bracket creep. So this is one of our favorite charts at the PBO. It's been used in a number of our reports, and it looks at our debt to GDP going back to the time of the First World War. And as high as today's debt looks and often gets reported as being all-time highs, debt is actually only about half as high as it was just after the Second World War. It was up around 100% of GDP. But we had a boom period after the war, and even though the government at the time was running deficits with very rapid economic growth, that debt was able to come down quite substantially. And then we've had periods where there've been up and downs with recessions and financial crises and the like. But more recently, we had the global financial crisis and then the COVID pandemic, which has driven our debt up to relatively high levels. Now, here's where we are at the moment. And our projections for debt are that debt's going to continue going up. But when we assess fiscal sustainability at the PBO, we don't look so much at the level of debt as much as what that trajectory is. And so even though debt's still going up, the fact that this line is flattening suggests that by the end of the medium term, we'll be able to keep debt to GDP at a relatively stable level. And that's consistent with a fiscally sustainable position. However, what I want to do is just show you what happens if we didn't have bracket creep. And you can see that it doesn't necessarily look like a big change, but the trajectory of debt is just one that continues going up over the medium term, which is not consistent with a fiscally sustainable position. And I can zoom in on that just to show you again, so you can see it a bit more clearly. Debt to GDP continues to go up, and that would suggest that if we didn't have bracket creep, governments would need to increase taxes elsewhere or cut spending in order to get that debt trajectory back down. So I guess to wrap it all together, from the perspective of efficiency, Australia is a relatively high personal taxing country, and we do raise a lot of our revenue from it, and there are some associated risks. From the equity perspective, what we're seeing in terms of the projections is that the progressivity in the personal tax system is coming down, at least in terms of the share paid by the top 10%. And finally, from a sustainability perspective, it's not a doomsday scenario, but debt to GDP is sustainable because of bracket creep in those projections. And if we didn't have it, then we might not be making that same conclusion. So I will finish up there, and if anyone has any questions, I'll be happy to answer them.